All right, let's talk about what happened in the markets today, Tuesday, February 3rd, 2026, because, wow, it was wild. We're diving deep into a day where global markets didn't just move, they completely ripped apart in opposite directions. We're going to unpack how the big story in tech, AI, literally split the world in two, sending Western markets down while the East saw a truly historic boom. So this is really the heart of the mystery, right? You're looking at the tech-heavy NASDAQ 100 in the US, down almost 2%. And on the same day, South Korea's Kospi index just rockets up almost 7%. I mean, how on earth does that happen? In a world that's supposed to be totally connected, that's the big puzzle we're going to solve today.
So here's how we're going to break it all down. First, we'll get into the two sides of this coin, why the West stumbled and why the East boomed. Then, we're going to look ahead and see what the predictive models are telling us about what's next. And finally, we'll walk through a specific strategy that's been designed to navigate this brand new landscape.
Okay, so first up, let's dive into the West. What was behind that wave of pessimism that just washed over the US and European markets? Because this wasn't just, a simple bad day. This was a symptom of something much, much deeper going on under the surface of that big AI story. So what exactly lit the fuse here? Well, this wasn't just some random panic sell-off. There were very specific triggers. You had PayPal coming out with a guidance miss that was so big it sent the stock down nearly 20%. At the same time, you've got the titans of AI like NVIDIA and Broadcom taking significant hits. Then you throw in this growing cloud of uncertainty about what the Federal Reserve is going to do next, and bam, you've got the perfect storm for a serious correction. But that begs the question, right? Why did this news hit so hard right now? Well, the first theory is something called psychological saturation. It's this idea that, the collective hype, the vibe around AI just ran out of steam. That powerful fear of missing out, the FOMO that pushed these stocks to the moon, it suddenly flipped. It became a fear that the bubble was just about to pop. And that really fragile mood ran headfirst into a brick wall, monetary policy. With the Fed hitting pause on rate cuts and maybe even signaling a tougher stance ahead, the era of easy money that fueled so much of this tech boom, it feels like it's ending. And that really hurts growth stocks because their big profits are way out in the future. When interest rates go up, those future dollars are worth less today, and that forces a major repricing across the entire sector.
And this leads perfectly into our next idea, the wall of worry. Look, markets are always climbing a wall of worry. That's what they do. But today, that wall, built out of bricks of tariff threats, shaky earnings, and that Fed uncertainty, it just got too high. The market tried to climb it, but it couldn't get over. Optimism just finally buckled under the weight of it all.
At our final theory, socionomics kind of brings all of this together. It basically says the stock market isn't a crystal ball. It's more like a rearview mirror, reflecting the social mood that's already out there. The argument is that this really negative feeling in society, people worried about inflation and politics, it eventually just seeps into the financial markets and overpowers any hype, even a story as big as AI.
And look, we've got the data to prove it. The University of Michigan Consumer Confidence Index came in at just 52.9. I mean, to put that in perspective, that is a shockingly low number, especially when you think about how high the stock market had been flying. It shows this massive, massive gap between Wall Street's party and Main Street's anxiety. According to the socionomics theory, it was really only a matter of time before the market caught down to the real mood.
And it wasn't just a US thing either. Over in Europe, markets were also in the red. But their problem was a bit more direct. They got hit with this Greenland tariff episode, basically a direct trade threat from the US that created this institutional shock. It rattled everyone's confidence and hit some of their biggest companies like SAP and Infineon hard. Okay, so take a deep breath. We're going to pivot hard now. Because while all that gloom and doom was happening in the West, the East was telling a completely, and I mean completely different story. A story of an absolutely explosive, historic rally. I mean, just look at this chart. It really says it all, doesn't it? A nearly 7% gain versus a nearly 2% loss. This gets back to that crucial question, how could two tech-heavy markets, both supposedly riding the same AI wave, have such violently opposite days? So, what's the answer? It's that the whole AI revolution has just hit a new stage. It's not just about the cool software and the fancy models anymore. Now, it's about the physical nuts and bolts, the hardware that makes all of it possible. And on that front, South Korean giants like Samsung and SK Hynix are the kings. They have incredible pricing power, exclusive deals, They're selling the picks and shovels in this digital gold rush, and business is booming. Okay, so now let's tie these two threads together, because these really aren't two separate stories happening at the same time. They are two sides of the exact same coin. The core argument of the entire analysis we're looking at today is this. We are witnessing a massive global rotation of capital. Money is flowing out of what many now see as the overhyped, maybe overvalued U.S. software names, and it's pouring into the essential and frankly cheaper hardware players in Asia who build the very foundation of this entire AI system. Okay, so that's the story of today, February 3rd. We've covered the what and the why. But what about tomorrow? What does this mean for the rest of the month? Now, it's really important to remember, what we're about to see is based on quantitative model simulations from the report we're analyzing. All right, so the models are spitting out three main possibilities here. The most likely scenario, with a 55% probability, is that this rotation from software to hardware just keeps going. The number two scenario, at 30%, is that those trade threats get worse and drag all the markets down. And then there's a smaller, 15% chance that the US market actually finds its footing by rotating into other sectors besides tech. And this isn't just a guess. There's some hard data behind this thinking. This is a technical indicator called the trick slope, and it just measures market momentum. You don't need to be a technical wizard to see what's happening here. The momentum for the Kospi is positive and going up. For the NASDAQ, it's negative and going down. The trends are literally pointing in opposite directions. So, this all leads us to the final and maybe most important part. What do you do with this information? Well, the report lays out a quantitative framework based on everything we've talked about. It's called the hemisphere dispersion strategy. Let's break down exactly what that means. So the strategy itself is basically a classic pair trade. It's built in three parts. First, the long leg, where you get exposure to those Asian hardware leaders who are winning right now. Second, the short leg, where you take the other side of the trade against the U.S. software and tech indexes. The whole idea is to profit from the gap between these two getting wider. And then there's a third piece, a hedge to protect against some big, unexpected global shock. Now, here's the really crucial part. This isn't just a vague idea, it's a concrete plan with very specific rules. It defines a clear stop-loss signal based on the U.S. dollar index, which is a great barometer for global fear. It sets specific profit targets, and it even tells you how to hedge the position. It's a disciplined, rules-based approach, not just a gut feeling. And really, this final quote from the report we've been analyzing just nails it. The events of February 3rd, 2026 mark the end of undifferentiated AI exuberance and the beginning of structural infrastructure dominance. We've moved past the phase where just slapping AI on your company was enough. We are now in an era defined by who controls the tangible infrastructure that makes it all run. So that's what it all boils down to. It leaves us with this one massive question. Was today just a single, crazy volatile day, or did it mark the real beginning of a new infrastructure supercycle that's going to reshape how we invest for the next decade? It's definitely something to think about. Thanks for tuning in to this analysis today.